Let's go now to what we've heard from the RBA Governor in the past hour. Our business editor, Ross Greenwood, joins me. Ross, translate this all for us. What's happening in the world of QE and rates?
Yeah, well, I've tried to explain to people that this is a little bit like if you're driving, you take your foot slightly off the accelerator. It's not like you've hit the brakes. It's not like you've done anything. Indeed, you're still wary about the conditions around the place. But it would be fair to say that the acceleration, if you like, or if you like, the throttle is pretty much still wide open. They've just taken their foot off just slightly. So effectively what they're doing at the moment is buying back $5 billion worth of bonds every week. They're going to, from September, ease that back to $4 billion a week. So it's not like they're going to stop. It's not like they're even suggesting interest rates are going to rise. So the Reserve Bank Governor today has indicated that the first sign, they believe, of any interest rate rise in Australia might be 2024, notwithstanding the fact that the US Federal Reserve, even the Bank of Canada, the Bank of New Zealand, have all indicated that maybe there could be rate rises by late next year. But there's other issues also at play here, and included in this is employment. The Reserve Bank is looking for more jobs to be created in Australia. That obviously is impacted by the fact that we have closed international borders now. And he says there's no real inflation in our economy, underlying inflation that is. And so as a result of that, this is part of the reason why the interest rates will stay so close to zero, why the government and the Reserve Bank will keep stimulating Australia's economy. I asked him about those closed borders, but also the whole issue about, well, what is full employment? Because historically that's been suggested to be 4 point something. Some are suggesting now it could be 3 point something. So I put that question to the Reserve Bank Governor just a few minutes ago.
What is full employment now? Does that, in your mind, have a 4 in front of it or a 3 in front of it? And the second one is in regards to the wages inflation. How much of your assumption is based on the timing of the reopening of international borders?
In terms of full employment, I wish I knew the answer to that question. I suspect what we've got to do is keep the unemployment rate in the low 4s for a period of time. In the short term, the closure of the borders, I think, is having a significant effect on the economy. It's obviously affecting people's lives, and it's affecting business decisions, and it's affecting the labour market. I think it's a plausible central case that over the next year we see a gradual opening of the borders, particularly for workers who have skills in short.
So Philip Lowe there, Tom, also indicated that, well, look, if the borders are still closed in 18 months' time, if the vaccination rollout hasn't seen a situation where Australia can open its borders, well, then really that inflation outlook, even that wages outlook and the jobs outlook in Australia could have changed again by that. So he's not trying to lock himself into any strategy right now, but he's trying to give his best assumption, I guess, as to where interest rates and indeed the overall economy is going to head over the next 24 months or so.
It's not enough for inflation to be forecast to be in this range. We want to see results before we change the cash rate. Any increase in the cash rate will take place after bond purchases have ended. I want to emphasise the point that the condition for an increase in the cash rate depends upon the data, not the date. It's based on inflation outcomes, not the calendar.
So he was talking about rates there, Ross, sticking with that 2024 timeframe again, as you mentioned, it's a for now thing, but any indication he'd shift and go with the overseas momentum, not happening for now. Did he mention the momentum in the housing market, though, the other big factor here?
Yeah, he really did, yeah. So the interesting part about this is really all about the credit quality inside the banks. In other words, are the banks lending to people they shouldn't be lending, and are they lending too much money? As we know, house prices in major capital cities, but even regional areas, are going up at a very rapid rate right now. And what they're worried about is, of course, that credit growth, in other words, the amount of debt that people are taking on, is much, much larger than their wages growth or their capacity to pay. Now, what he has indicated here, and this is important, is if it gets to a point where they see simply people are taking on too much debt, in other words, creating dangers for the banks, dangers for the individuals themselves, then it's likely that the bank regulator, APRA, plus the Reserve Bank will come together to again take the type of action it did several years ago when they started to limit the amount of growth or credit growth that the banks could issue. In other words, to limit the amount of debt that was being handed out. Now, this really right now flies in the face of what the Reserve Bank is doing, printing money, making certain there's lots of debt for banks to lend in the housing markets right now, which is leading to these higher house prices. But at least he's got a weather eye out, you can see, for these very high house prices and indeed for the amount of debt that families are taking on. Because it's been indicated many times it wouldn't take much in the way of interest rate rises for many households that have taken on too much debt to end up in a significant amount of stress. So we talked about that as well today.
All right, well, that's something they're keeping an eye on, I know, but he's been bullish, hasn't he, around that sort of stress level in housing throughout. Ross Greenwood, thank you.